Hello and welcome to Markets here from New York. Well, this week everybody's talking about volatility. Is it back or is it just a classic head fake? Joining me now to discuss why volatility matters to investors is Tracy Alloway, who's our markets correspondent here in New York with me. Tracy, what's happening with volatility? Why has it been so low for so long and why is it suddenly picking up?
Sure. Well, I think low volatility has really been a defining feature of financial markets in recent years. Most of it is caused by the massive, extraordinarily unconventional monetary policies undertaken by central banks in recent years. These really encourage investors to basically stay in the same position. Everything kind of moves as one. The whole point about QE is that you suppress market volatility, basically. So we've seen that over the past few years. Now what we've seen in the past month or so is a little bit of a return of volatility. Some investors are reassessing positions in certain asset classes, and we've seen a little bit of a sell-off in certain assets.
Now, volatility is actually a good thing as long as it's somewhat contained. It's sort of seen as being a disciplinary type of action that compels investors to not chase assets and chase returns too far, too fast. I mean, looking at the asset classes, it's quite notable looking at the performance of junk bonds in the last couple of weeks. And traditionally, junk has been the tipping point of much bigger sell-offs in the past. And do you think we're seeing something brewing here?
Sure. Well, I think what's happened with junk bonds over the past month is really interesting and potentially key to understanding everything. Junk bonds are usually a sort of leader in terms of market sentiment. We saw record outflows from the asset class over the past month, and that's after, months and months and months of inflows into the sector with not a single outflow. That's crazy.
Yes.
Now, the big question is whether volatility will spread to other asset classes. And I'm curious to see whether you think there might be a tipping point that investors should really be looking out for right now.
Well, that's interesting because we have a third slide here which shows the equity correlations for the top 10 sectors in the S&P 500. And what we've seen as VIX has risen from 12 to 17, the correlations have gone from under 70% back to 75%. Now that's way off the highs we saw around 95% in 2011. When essentially everything was selling off together or rallying together. Correlation is tricky because once we go into that strong risk-on, risk-off mode, it sort of creates lots of problems for investors. And at the moment, this year has been very much a year of being the year for the stock picker. So correlations have been falling, and instead of just betting on everything, you've had to actually make selective choices. So potentially, as VIX begins to rise, and in particular if it goes over 20, which in the past has been that red flag signal, and which has then led to much bigger rises in VIX, correlation tends to also start to rise, and it sort of really hurts the stock picker and those who've been trying to do fundamental analysis and just back companies based on their merits rather than just saying, okay, just stick everything on one place and hope for the best. So we will see what happens, I suppose.
I guess what we have here is a return of volatility, a minor return. We need to wait and see whether it spreads into something bigger.
Great. Well, on that note, thanks so much, Tracy.